Hello and welcome to everyone. Today is the ninth lecture and second week. Today we are going to discuss the financial data. So in the previous classes we have discussed different markets, different financial instruments, and in the beginning of the course we have discussed that we wanted to find out the behavior, performance and dynamics of those markets and those instruments. So how we do that? The first thing what we need the information on the performance conditions of those financial instruments and behaviors. So how we capture those information? So once we record those information, that's what we call the financial data. The financial data can be defined in generally what we mean by the financial data, that it refers the quantitative information which we record about the health or conditions or the performances of the financial markets, financial institutions, maybe companies or firms, or different financial instruments. So once we record those informations in the quantitative form, that's what we call the financial data. However, here primarily we are concerned in this particular course about the information which we record in form of prices, returns, or other metrics related to specifically the financial markets and the financial instruments. For example, in case of India, what we have BSE 100 or the Nifty 30 or the stock prices of the HDFC Bank or any other company or the firms. So these are the basically some of the examples we have of the financial data. The financial data could be historical or could be current. For example, today's stock prices or the today's the value of the BSE 100 or the multiple companies, those are the basically the current information we have. However, let us say we wanted to know the prices of the, let's say, HDFC Bank from since 2002 till now. So those are the basically historical prices or historical information we have. So it could be historical or it could be current. Similarly, we can categorize on based on this similarly it could be periodic or it could be need based or need basis we can have. So if we are recording at a certain interval, then it could what we call the periodic, for example daily, monthly or quarterly, or whenever we need some data we record those of informations, observe those information, that's what we call the need basis. So why we are concerned? So the first important aspect of the financial data is that we, for any decision making, we need the financial data, we need the quantitative information for that particular institutions, for that particular financial instruments, or for that particular particular financial markets. So the first, any decision making, for example, if you are concerned with the financial instruments for the trading, investing, or the risk management of the portfolio, what we need the information, that too in the quantitative form. So that is that means we need the financial data. Similarly, it is also very critical for modeling, forecasting, and understanding market behavior. So if you wanted to understand the market behavior, or we wanted to build some kind of model to predict or to forecast the particular financial instruments or the financial markets, then there also we need the quantitative information about that particular assets, financial markets or company or the firms. And that means once we record, that becomes financial data. So financial data is very important for any decision making or for modeling or for the understanding the dynamics of the financial markets or the financial assets. Therefore, we are very concerned with the financial data. And here, as we have discussed, we are primarily concerned with the price information, of the different assets or the financial markets. So let us say here we use the prices of those uh, financial instruments. So what we call that asset, we call it, in general we call it asset prices. So this asset price at time t, usually denoted by pt, basically represents the value of the different financial assets, for example stock or bond or derivative or futures, at a specific point in time. For example, we can say the daily closing prices of a particular stock or the bond, and the PT minus 1, as we have that is the price of the same stock at the previous time period. Then these asset prices we use for calculation of returns, and we also use for portfolio management. We will see that for the portfolio management we need for both the return as well as the volatility of financial assets, and both this we calculate using the price of the particular asset. Or similarly, if you wanted to analyze the market trend, uh, how it has performed over the certain period, then again we resort to the prices of the assets. Then there are the different ways we can categorize the financial data. So one of the common ways of categorizing financial data is based on the structure of the financial data on time and space. So when we record the financial data over a certain interval of period of time, then we call it the time series data. For example, prices, returns, and volumes over a period of time, for let us say 1 year, 1 day, 2, over the month, over the years, over the 10 years. So those are the basically example of the time series data. So we record the data on a certain interval period of time. Then the cross-sectional data, here we are not observing across the time, or sorry, over the period of time, rather than at a certain point of time we are observing across the different units. For example, if you are observing the returns of the multiple stocks on the same day, so that is the cross-section, example of the cross-section data. Whereas the panel data, this is basically a combination of both time series and the cross-sectional data, where we observe the certain units over the period of time. So that is the panel data. So we can represent here, so let us say if we are recording or observing the data, let us say of the stock prices of HDFC, for the, let us say if it is yearly or the monthly, so we say the first month, second month, third month, fourth month. So if you are observing these observations here, then this is the example of time series data. However, at a certain period of time, let us say for first month, we are observing the data of HDFC, maybe the Axis Bank, and any other banks for this particular point of time. So this is the example of the cross section. However, we are observing the data for more than one cross-sectional unit. So let us say here again HDFC and Axis Bank for the multiple periods over the period of time, then this whole structure is the example of the panel data. So based on this, we can categorize the financial data on the time series, cross-sectional, and the panel data. Primarily in this course, we are concerned with the time series data. And the reason behind it is that specifically this financial data, they have certain kind of characteristics when we put in the time series data. So we wanted to use those characteristics to build the model to forecast the particular variable and to analyze the behavior of the market over the period of time. So here for this particular course, our focus will be on the time series data instead of cross-sectional and the panel data. Though in the recent year there have been development in the panel data as well as the cross-sectional data, also specifically for the financial markets and instruments. In general, there have been quite development of about cross-sectional data as well as the panel data. However, in case of the financial econometrics, these phenomena of the cross-sectional and the panel data is recent. Then sampling frequency. When we say the sampling frequency, what we mean, how often we are recording or observing those quantitative informations. How frequently we are observing. So that's what we mean by the sampling frequency. For example, it could be daily data. If we are taking the, let us say, stock prices, so it could be observed daily, it could be hourly or tick by tick. So these are the, then we'll call it the sampling frequency. Why we are concerned sampling frequency? It has very important implications, specifically in the financial econometrics. In the later classes, we'll see that how the frequency does have the effect on the different models. In fact, there have been separate models for the depending on the frequency or sampling frequency of the data. Then how we record what is the sampling frequency? It reveals a different kind of information. So based on the sampling frequency, we can say it could be regular or it could be irregular data. When we say the regular, what we mean by the periodic, the period over which we record is the same, consistent we have. However, when we say irregular, it means the periodic difference from one point to second point is not consistent. For example, when we say daily data, so the first day, second day, third day, fourth day. So this is every day we have the difference of one day. So that is the basically regular data we have. However, let us say if you are recording data first day, second day, but in the next fifth day, maybe sixth day, then maybe ninth day. So there is no regular phenomena we are observing here. So the time gap between the two observations are not consistent, not same. So then we call it irregular. Then based on the what is the gap between the two observations, so that what on that basis we call high and low frequency. And this high and low frequency, it has a very important application in case of financial econometrics. So let us discuss this high and low frequency with a little detail. So this is the base graph of the daily prices of the stock prices for HDFC Bank. Here NSE, basically National Stock Exchange. So that's where. So it shows how over the years it has been fluctuating and improving over the year. So this data starts from the January 2023 and it ended is the here this January. So this is the 1 year time period, and we can see the fluctuations and the trends of the prices of the HDFC Bank. Then what is the low frequency data? So the data collected over a longer intervals, that is maybe the daily, monthly, yearly, quarterly or half yearly. So those are the basically known as the low frequency data. For example, closing stock prices or the monthly GDP figures or the monthly IAPs or the quarterly GDP figures. So these are the examples of the low frequency data. It has a certain advantage and it also has a certain disadvantages. One of the advantages is it is easy to handle, store and process. It will be less noisy, providing a more stable trends and the patterns of the behavior of the asset or the financial market. It is suitable for the long-term investment strategies. However, it has a certain disadvantage that it misses the short-term fluctuations and the intraday patterns. it may overlook the very important market microstructures, day-to-day changes or hourly changes if happens. So then that, and especially in the financial markets and the financial instruments, we often observe these macro structure phenomena. For example, if there is the election day result is coming, so in the beginning the financial assets or the stock prices will behave differently than by the evening when the results are clear. So these are the certain phenomena we can observe here. So if you are recording the day to day, daily to daily, or monthly or the weekly data, then we miss those the macro structures or the short term fluctuations. So, for example, this is the closing daily closing price of HDFC starting from first month January to here second month uh, the February. So this is the daily prices we have. So that means this is an example of the low frequency data. On the other hand, what we have high frequency data. When the data collected at very short intervals, for example, seconds, milliseconds, minute by minute, hour by hour, these are the examples of the high frequency data. So low frequency data means the period collecting between two observations is minimum daily or more than that, then we call low frequency. On the opposite hand, if it is less than day, hourly, minute by minute, second by second, transaction by transaction, or tick by tick, then what we call the high frequency data. For example, tick by tick stock prices in algorithmic trading. So those are the basically example of the high frequency data. It provides a detailed insights into the short-term fluctuations. It has advantages that we will be able to capture the very short-term fluctuations. For example, as we discussed, the election day effect on the trading day effect on the stock prices, we can observe that. It captures the market macro structure and the intraday patterns within the day, what happened, what are the changes happen, occur, how it behaves. So those things we'll be able to capture when we have the high frequency data. And it is very useful for the algorithmic trading and the arbitrage opportunity. Arbitrage basically we see is the phenomena where if there is the difference between the two markets, prices in the two markets, or then or the two assets or the two time periods, then the certain people will they want to take the advantage. So if there is the high and here we have the low, they can buy here and sell it here, so to earn that. So what we call the arbitrage opportunities. So for if there is the very and that is opportunities are can be realized only when we have the high frequency data. However, it has the certain disadvantage that it is quite noisy and the less reliable. We cannot uh, use it for the long term strategy, and sometimes it becomes misleading. So therefore, and because of that high variability and the noise, it is very difficult to use the high frequency data for the forecasting or for the volatility modeling. And there have been the certain development in the modeling aspect where we use the different models for the high frequency data. For example, we will see that when we discuss about the volatility modeling, how to model the volatility, how to examine the behavior of the volatility. So in that case, we have, for example, there is the models what we call arch and gauge models. So there we will see if we have the high frequency data, instead of using arch and gauge, we prefer to use the realized gauge or the realized volatility. So it has the certain advantages as well as the certain disadvantage, and over the years there have been the certain development in the modeling aspect and econometric aspect and the tools and technique aspect where we are able to deal with the high frequency data. So this is the example of the minute by minute data of the HDFC's closing prices, and it starts with the first January until we have the 22nd February, and this is the time period we have. So these are the time period we have. It starts from 9:15. So every minute this has been recorded. So we can see how much there is the fluctuation. So this is very noisy data we have. So here if you see in this case here what the fluctuation, so every minute there have been the fluctuation and observation. So this is an example of the high frequency data. Now for a given sampling frequency, the prices can be recorded at a certain different times within that observational period. For instance, so then for a given sampling frequency, the prices can be recorded at the different times within the specified period. And based on that, when we are recording, when we are observing those prices, what we have the four category of that, what we call the opening, closing, high and low, and there is also another concept what we call the adjusted price. So these are specific to the asset prices which we are going to deal in this particular course. So asset prices could be recorded at certain period of at certain point of time. So if we have, for example, if we are dealing with the daily frequency, so in that case that we can record it, the opening price, that is the price at which a security first trades upon the opening of an stock exchange or the exchange platform wherever it is being traded that particular trading day. So that's what we call the opening prices. It reflects overnight news and the market sentiment. So what is happened over the night that could be reflected the moment it opens the exchange and we have the price of that particular asset. If certain bad news comes in night, that could be reflected into the prices of that particular instrument of particular company's stock price. So that's what we say, it reflects the overnight news and the market sentiments, and we can capture that using the opening prices. Similarly, we have the closing prices, where the closing price is the final price at which the security is traded on a given trading day at a particular exchange platform. And this represents the most up-to-date valuation of the security. So over the whole day, what happens? So at the end, you have the most updated value of the particular asset. And often we use the close prices for the portfolio valuation and index calculation. However, not only we use for the portfolio valuation index calculation, often in the empirical models we use the end of the period, that is the closing prices. So whether it's to calculate the return, whether it's to calculate the volatility, whether for the purpose of the risk management, whether for the purpose of the portfolio optimization, whether for the purpose of the pricing of the derivatives. So usually we use the closing prices in the empirical models. Then another we have category that is high and low prices. So basically high price is the nothing but the highest maximum price in a particular day, if we are recording the daily frequency. If it are recording weekly, then obviously within the week. So that's the basically maximum price security traded during a particular day. In opposite of the lowest is the minimum price a security trades during a particular day, and it indicates the range of market activity within the trading session. So if there is the quite range is large, that means there has been the quite market activity have been, there is quite fluctuations we have. Then there is another concept what we have the adjusted closing prices. So adjusted, what we mean by the adjusted closing prices? Basically we adjust the price for any corporate news actions. For example, if they are splitting the stocks, whether they are sharing the dividends, whether they are merging with anyone, whether they are acquiring some other company. So any action if they take and that have impact on the prices. So if we are adjusting the prices for that particular impact, then what we call the adjusted price. And basically it provides a true representation of the securities value over time. Let us take an example to understand this better. So let us say in the day 1 what we have, the stock trades at the rupees 100, that is the price we have. Now the company issues a 2-for-1 stock split that on the second day. That means each share is splitted into two. Now, without the adjustment, the day 2 closing price would show up rupees 50 and the day 1 closing price is showing rupees 100. That means we see a difference in the closing prices of rupees 50. So, which is quite a huge difference we have. However, if we adjust the price calculation, that is, the adjusted price will be original closing price split factor. So, in the day 1 what we have, the original price is 100. Split factor is 2 if we divide 50. Now we can see there is no change in the price day 1 and also into the day 2. So that's why we say the adjusted price. So adjusted closing price for day 1 is rupees 50 now instead of 100, making it comparable with the day 2 price. This adjustment ensures the accurate trend analysis and the historical consistency. Otherwise, here we would have been break of 50 in this case here. So that's what we mean by the adjusted price. So almost in every stock price, whenever we record the data, we have the data or we download the data, we'll get all those 4 high, low and closing and adjusted prices. For example, here we can see this is the HDFC Bank's register on the National Stock Exchange we have. So you can see here these are the different day we have, and every day we have the price open, so that this price when the first trading happened on this particular day. Similarly, in the 21st November when the prices was the trading was open, the prices was this, and same day if you see here the closing prices is 745. So you can see the November 21 the closing prices was 741.2, and the next day when the market opens, that is on the November 22, this 7041 is no more. Now it is 1743.55. So this increment basically, so here we have the trade closed, and here it is opening, but this difference in the prices basically reflects the overnight phenomena what is happened, and that is reflected into the opening prices. And here is the closing price. So it opened with this, and here it is closing with this. And that during this particular period, the maximum price it peaked is 1754.30. However, the lowest price was 1729.55. And here what we have adjusted closing prices. If you see here the closing and the adjusted closing both are the same, that means there was no such any action by the particular company. So there were no stock dividend or there were no stock split or something like that happened. So therefore the closing and the adjusted closing will be similar. However, whenever we see there is some kind of dividend announcement and all that, it may have the impact on the adjusted and the close prices. And if we draw all these high, low, open, close, and so here we have the close, high, low, and open. So you can see there is the marginal difference we have. So that's the graph of all the 4 open, high, low, and close prices of the HDFC Bank. And here we can observe that particular pattern, how it is there. So there is the little gap will be there among these the 4 price matrices. Then next important aspect which we must know here, because that's what we are going to use often in case of our next course, next of the classes of this particular course. That is the concept of prices versus return. So however, we do record or we observe the prices of the in the financial markets. However, whenever we are dealing with or we are using those prices for any modeling or analyzing or the forecasting purpose, we do not use those prices, rather than we use the return of those prices. Now, why we do that? The reason for that, while we are doing modeling, we need the certain kind of characteristics and properties of the data. Okay, that the data should follow a certain property or certain characteristics. Those desirable characteristics which we uh, think should have the data for the finance for the modeling or to be used in empirical models are often not present at the price level. One of the critical aspects of that is the stationarity and non-stationarity. However, in the coming lectures, in detail, we'll discuss about the concept of stationarity and the non-stationarity. Here, quickly, we can observe that when we say stationarity, that means the mean, variance, and covariance of the particular series is not time dependent. It is the gap between the two time periods. It depends on that particular behavior. It does not depends on time. That is, if you are taking the average of the particular series for, let us say, 2000 to 2010. So if you are taking the average of a particular series from 2000 to 2010, that is the gap of the 10 years. If it is, let us say, x bar here, then if you are taking now from 2010 to 2020, since the gap period is the same 10 years, then this x bar and this x bar should be the same. So that's in general one of the mean, and the variance should also behave like that, and the covariance should also behave like that. Then we call that is the data is stationary. If it is not there, then we call data is non-stationary. In the graphical form, we can say basically, so if the data is non-stationary, it could behave like this. However, if the data is stationary, it could behave like this. So the long-term average mean will be similar. We prefer to use this kind of data which have the correct properties of stationarity. So that is the primary reason we have that why we use the return instead of the prices. Now the return could be calculated either and based how we calculate the return, based on that we have the two concepts of return, that is the simple return or the net return, and the continuously compounded or the log return. So what are these returns we have? So the simple return or the net return, the measures the percentage change in the price of an asset over a given time period. So most of you will be familiar with the percentage change, how we calculate. So percentage change, how we calculate the value in the current time period and value in the previous period divided by the value in the previous period. Then we multiply with the 100, and that is basic. Often we calculate this. The same way, if you calculate the return, so that is what we know as the simple return or the net return. So where the PT is the this and the PT price at the previous. For example, let us take that price at the previous period is 100. Now the current price we have 10. So then we can calculate the percentage change or the simple return or the net return, which could be 0.10 percentage. 0.10, or in percentage form we can say 10%. On the other hand, measures the natural logarithm of the ratio of the current prices to the previous prices. That is, if you are using RT, the log of PT minus 1, so then it is known as the log return or the continuously compounding return. So here, for example, the same we can take the two prices here, and if we are using this log, it comes out to 0.0953 and almost 9.53%. That means continuously compounding return is lesser than the simple return. One of the properties is that log returns are additive over time, making them useful for the time series analysis. What we mean in a minute, we will be able to understand that. So here is the example of the simple returns, and here is the log returns of the same data. So here we can see what is the changes we have. So in general, there won't be much changes until unless there is the large fluctuations we have. Similarly, we can calculate the return on the one period or the multiple period. So what is the one period of the single period return? Basically, return calculated over a single time period. The time gap is between only one. Whether it's day, that means only 1 day difference. If it is monthly data, that means there is only 1 month gap between the two data points. Or if it is annual data, that means there is only 1 years gap between the two data time points. So if there is the gap only of only one time points, then what we call the one period return. So for this is this similarly, and here we have this. However, in case of the multi-period return, what we have measures the cumulative return over a multiple time period. So it's not PT and PT minus 1. It may be PT and here PT minus 5, 6 or something like so, multi-period return. So that is, if you are using the simple, then measures the cumulative return over a multiple time periods. For simple return, we use this here. This pi is basically product, not the summation. It is the product of 1 plus RT minus 1 and this from T1 to TT, capital T. In the case for log return, what we have instead of multiplicative, we have additive, that is the summation here. So R total will be summation of RT from T1 to up to T. So for example, let us say here for R1 what we have 0.10 and R2 we have 0.05, that is 2 return. So it is basically PT return between PT and PT minus 1 and PT and PT minus 1 and PT minus 2. So this is R1 and this is R2. Then if you are using the simple return, then how we do 1 plus 0.10 plus 1 plus 0.5. So this is not additive, but it's multiplicative minus 1 here, and which turns out to be 0.155, that is 15.5%. However, if you are using the log return, then what we do, we are adding that 0.0953, that is the R1, and 0.0488 for the R2, and if we equate this, it becomes 14.41 percentage here in values here. So again, we can see there is the marginal difference we have. However, you can see here it is quite easy to add these two. However, it is comparatively difficult to multiply. Just imagine we have 10 periods or the 100 periods or the 50 periods, then it becomes quite complicated to multiply those figures. However, in the log return, it is quite easy. So often for this course, for this particular course, we will be using the prices of assets primarily, and for the empirical models, we will be using the return instead of price. So return we can calculate either the simple and the logarithmic. However, we prefer to use the logarithmic form, that is this PT upon PT minus 1. So often in the coming lectures, when we say return, invariably we mean the return of this particular form. So today we discuss about some of the aspects of the financial data, which is very specific to the nature of this particular course, and we will be using these concepts in our course. Thank you so much. See you in the next class.